You hear it all the time, right? That we're living in some kind of new financial era where all the old rules about money and investing, they're just dead. But is that actually true? Or is it a dangerous mirage? Well, today we're going to dig in and find out.
If you've gotten into investing recently, you've probably seen it firsthand. I mean, the incredible gains, sometimes in just a few days, from meme stocks, new crypto, and slick trading apps. It really feels like the entire game has changed. And that's an exciting idea, no doubt. But is it the whole story? We need to look a little closer.
So, let's just start with a quick reality check. You see these claims online? I can make 1% a day. But when you actually do the math, it's just, well, it's impossible long term. At that rate of compounding, you literally be one of the richest people on the entire planet in less than a decade. The real takeaway here, we've got to be able to tell the difference between some short-term luck and a strategy that's actually sustainable.
And that kind of thinking leads us to what are often called the 4 most dangerous words in all of investing. This time is different. See, historically, whenever markets start getting really overheated and euphoric, you start to hear this phrase everywhere. It's a classic sign of a bubble and honestly a huge potential red flag for investors.
Okay, so if this really is a mirage, why does it feel so incredibly real? Let's break down the anatomy of it, the actual factors that have been pouring fuel on the markets and making this whole new era idea feel so convincing.
And let's be real, it's been easy to get excited. For pretty much the last decade, high-flying, flashy growth stocks have posted some truly amazing returns. So if you're a newer investor, you'd be forgiven for thinking these kinds of gains are just normal. It makes that old-school, slow and steady approach seem totally obsolete, right? There have been 3 major forces pushing everything higher. First, ever since the 2008 crisis, interest rates have been at rock-bottom levels, which lets companies borrow money super cheaply to grow. Second, you have central banks using something called quantitative easing, which basically just floods the financial system with cash. And third, and this one is crucial, we've seen this thing called massive multiple expansion. That just means investors have been willing to pay more and more money for the exact same amount of a company's profit. Let me show you what I mean. This visualizes that third point perfectly. If you look at the period since 2010, stock prices have shot up about twice as fast as the actual profits those companies were making. So in other words, the excitement has run way ahead of the results. Investors have just been paying a higher and higher premium for the same dollar of earnings. So that explains why things feel so different right now. But is this pattern really something new? Not at all. Let's take a look at history, which, well, it offers a really powerful and kinda sobering lesson. We have absolutely seen this movie before. Does the dot-com bubble ring a bell? Back in the late 90s, the story was identical. The internet was this revolutionary technology. It was going to change everything. And so valuations for anything with a .com in its name just went to the moon. But eventually, reality set in and the whole thing burst. And here is the absolute key to all of this. The internet did change the world, just like everyone said it would. But that simple fact didn't change the fundamental laws of finance. When the profits couldn't possibly support those crazy sky-high valuations, the market corrected hard, and a lot of people lost a lot of money.
This brings us right to the timeless principles, the stuff that has held true through every single market cycle, every boom, and every bust. We're talking about the unchanging math of investing.
You know, at the heart of all investing is this one simple idea, the risk-return trade-off. It's like a fundamental law of financial physics. Technologies change, markets evolve, but this relationship, it doesn't. If you want to chase those higher returns, you have to accept higher risks. There's just no way around it.
So, what's a realistic expectation then? Instead of dreaming about 1% a day, history gives us a much more grounded benchmark. Over the last 90 years, the average annual return for the S&P 500 has been about 9.8%. It's a good idea to use that as a yardstick, just to keep your own expectations in check.
Look, I get it. It's not nearly as thrilling as some moonshot trade you see on social media. But this is where real, lasting wealth is actually built. Compounding, the simple act of earning returns on top of your previous returns, over and over, is the single most reliable way to reach your long-term goals, like a comfortable retirement.
All right, so with all that in mind, how are you supposed to navigate a market like today's without getting swept up in all the hype? Let's put together a long-term playbook.
First things first, a word of warning.
This whole new financial era idea promises a shortcut to getting rich, but history shows us time and again that these so-called shortcuts are usually just value traps that lead to capital impairment, which is just a fancy way of saying you lose your money, and it can take years, sometimes even decades to get it back.
So what's your best defense against all this? It's simple, really. You do your homework. Use fundamental research as your guide. You need to actually understand a company's financials, analyze its competitive moat, its long-term advantage, and most importantly, you have to figure out if you're paying a fair price for its future. That is the bedrock of building long-term wealth. And so we're left with that big question. When you look at the forces driving the market and you consider the sobering lessons of history, what do you see? Is it a mirage built on cheap money and hype? Or is this time really different? The answer to that question will shape your entire investing future. Thanks for tuning in. Stay skeptical out there and stay rational.